Hello. So till now we have learnt about Nifty as an index, and then also about ETF, exchange traded funds. And in this section we are going to learn about index mutual fund. And objective is same. Objective is what are the means and methods through which you can basically invest into equity market without taking anyone's help, without devoting much of your time in research. And that's where I have identified these two products, ETFs and index mutual fund. And in the very early stage of this course, I wanted to tell you about these two products. Right. So yes, they are those products where you would need little bit of research, but more than research, what you would need is basically exposure and the knowledge about these two products. Why you can consider these products also in your overall portfolio of equity investments. Right. So let's understand that what we are going to cover into this class. So the very first thing is like investing in a stock market through mutual fund. So what exactly is mutual fund is something which we will learn. Then we will learn the difference between mutual fund and direct equity investment. You are doing this class because one day you want to do direct investment into equities, shares or stocks, whatever you call it. Then since it is a class where I'm going to tell you about index mutual fund, I'll tell you about different type of mutual fund, then pros and cons of mutual fund investing, then what is the alternative of index mutual fund, which we have already covered, but then what we need to also know is comparison between the alternative of index mutual fund, which is ETF. So in the next section, rather not in this section only, but in the next section, we will do the comparison between both of them so that you can wisely select which one you will prefer, which will be suitable for you. Right. What I have also written here is investing passively in index fund or investing passively with index fund. Passively investing where? In equity market. Right. So before we go and learn about index fund or mutual fund, why not we first understand that what exactly is mutual fund and then what is passive investing. So let's first start with the mutual fund thing. Mutual fund is a financial product from asset management companies. So I know you have heard about this definition a lot many times, that mutual fund is a collective fund of so many people like you and me, which fund gets invested into equity market or other market. However, how I would like to define you first, that it is one of the financial product from asset management companies. So there are companies who get license. Those licenses are very expensive, and then they get a approval from authorities that they can pool fund from different people and invest it, and in return they will charge you some fee. So on charge basis, they promise you to manage your investment and get you better returns. So these products have one objective, and that objective is to give you better returns than market, better returns than what you can generate for yourself. This is what they claim for, and obviously they charge you for that. Now, one professional or group of professional hired by asset management companies take decision to invest common person money. So this is what is mutual fund. These are the attributes of the mutual fund in my own words, which I have told you. But yes, the definition remains the same. Mutual fund is a collective fund pooled through many retail investors and managed by one or two professionals or a team of professionals. The number could go to as high as 20 people also. But at the end of the day, being managed by one professional company. These companies are generally called asset management companies, and their charges are good charges, means anything between 1.5% to 3% kind of charge. They charge you on equity mutual funds, not on all funds, but equity mutual funds. Right. Now, what is passive investing? And most important thing, active and passive, these two words when hit your mind, what do you think? Active is something where you are actively involved. Means mutual fund must be a passive investment? This is my question to you. Do you think or do you visualize that mutual fund are passive investment for you? Well, no. Mutual fund is not. But before that, let me tell you. So a philosophy of maximizing return by minimizing your cost of buying and selling by not participating actively in market is called the passive investing. So a passive investor believe in value investing and he put his money into one asset class for a very, very long period. It could be 10 years, 15 years, or till the time he don't find the fundamental of those assets going wrong. So there are so many products. A person who is buying land thinking that, okay, let me buy land and I'll keep it with me for another 10 years, 15 years. Post retirement, I'll go and enjoy on that land, probably construct my farmhouse. So he is a kind of person who is a passive investor. He have a belief that this land price in this country will keep on going up. And how he formed this belief? He has seen it in the previous generation. He has been seeing in his own last 10-15 years of experience as well. So he is a passive investor. He is not very actively checking what is the rate of that land going, whether he has to time that and sell as soon as he get double money and invest into somewhere else. So there could be a person who will buy land within 3 years. He will sell it and buy cheaper land somewhere else and again think of for a price appreciation. These people are timing the price of the land. I know some people like that also. So here in equity market, obviously in land also, when you go buy and sell, you give lot of transaction cost. That could go to as high as 8%, 10%. Right? In equity market also, every time you buy and sell, you give money to the broker. There are expense ratios like transaction cost, impact cost, and so many other stuff. And most importantly, there will be always a timing issue. You might think that this is the best time I can sell and there will be enough return left into that stock. So passive investor believe in very, very long-term investing. Okay. However, when we talk about mutual fund managers are not passively investing into equities. They are constantly checking, at least this is what they claim, that they always try to find good opportunities, and that is why they are charging you 2.5%, because they are claiming that they will keep on looking for the health of the company where invested. They will keep on looking on the competition and always try to see whether they are invested into the best of the stocks or not, or whether they have the alternative stocks where they can shift. So holding equity mutual for a long period is not a passive investment, because internally the fund is actively managed. But there is one special type of fund which provide you this feature of passive investing, because this fund believe in one concept that this market is going to be here and it has to keep on growing, right? So now that you learned what is mutual fund and you have learned what is passive investing, let's, even before jumping on that specific type of fund, let's first pause a minute, and since we are now have learned enough about the mutual fund, just compare between mutual fund and direct equity. So in mutual fund, the fee can be as high as 3% of the total fund. In direct equity, when you invest, you are doing this course for the direct equity. I am a big promoter of direct equity rather than mutual fund. As a teacher, I do have a responsibility to tell you that where my belief is. So my belief is what is right or what is wrong. So what I really don't find in mutual funds is in equity mutual fund, the fees are very high. A country which is not growing at 7-8% GDP anymore, if you are if you are going and charging 3% kind of fixed fee or 2.5% kind of fixed fee, this is quite a high charge. If this charges comes down to 30 paisa or 40 paisa, 0.3 or 0.4%, I'm fine with it. Because what happens that whether the fund give the return to the client or not, this money keep on getting deducted every year from mutual fund investors account. So when you put your 100 rupees, they keep 2.5 rupees aside and they invest 97.5 rupees into direct equity market. And that's how they have to generate a much better return to give you a decent 10-15% return. And that is why I'm not a big fan of mutual fund, and I believe in direct equity more, and that's why I have launched this course also. Now, in mutual fund, it is your money, but someone else take decision. When you invest into direct equity with some knowledge, it is your money and you take the decision. So whether you have a judgment of some company which is like a good company or better company, that could not be the same judgment of the mutual fund manager, right? Then in mutual fund, what have been observed, again I have written here, I'm not making it as a claim, but what I have observed is that there is always a limited return. You would hear that, a mutual fund, you probably invested a lump sum amount, have given you on an average 15, 16, 20% return in a year for, let's say, 3, 4, 5, 10 years continuously, which is still a very good return. But very few of them have given in India. Okay. Now, when we talk about taking risk in businesses, you would have heard many stories where a company's stock of 10 rupee or 15 rupee or 30 or 50 rupees also become 50,000 rupees, have given multiple times of return, right? So that's one difference which again I find between mutual fund and direct equity, that in direct equity you can have exponential return, which have been also observed. Again, this is a very a statement which is my observation, which I can tell you. You will not find it in books, but yes, if you think through, you will also realize that there is a very high chance that you are investing into a company which is having just a net worth of 100 crore and it becomes 10 lakh crore company. Reliance is one of the example. When it started, it didn't start with even 100 crore net worth. Probably, I don't remember right now, but probably 10 crore of net worth or 5 crore of net worth. And right now it is 7 lakh, 8 lakh crore company. So the direct equity, if you are really good with identifying value investing, in direct equity you can have as high return as possible. So this is the difference between mutual fund and direct equity. However, I'm not here to promote or de-promote mutual fund, but just wanted to bring some clear pictures in terms of differentiation between both of the products, which I told you. Now, let's talk about one thing, or you think about this. Instead of investing into shares, can you invest into Nifty and Sensex? Well, yes, you learned it, and you learned in the last class that through Nifty ETF, you can directly go and invest into where? Into Nifty and Sensex. Nifty and Sensex is nothing but the market. And can you do it yourself? Well, you cannot do it yourself. If you directly want to go and match and track a pre-component of Nifty, then it will become very difficult. Investment size could be high, and there where companies like companies which launches ETF or companies which launches index funds solve your problem. So what is index fund? And before we go and cover index fund, let's understand what are the different type of mutual fund. So first type is equity mutual fund. Invest mainly into equities, shares, stocks, and they have been categorized as large cap funds, mid cap fund, small cap, multi cap, thematic, sector specific. As the name suggests, large cap will invest into all large cap companies, mostly from Nifty 50, Nifty Next 50. Mid caps will go and invest into mid cap stocks. Multi cap will invest primarily into mid cap and large cap both, and they have to define themselves. Thematics sectors are the sector specific, so one certain specific sector, one mutual fund defines that they want to go and invest into infra sector, then they will pick up all the infra sector companies into that. Then you have debt mutual funds, which mainly invest into debt products, government securities, debentures, companies debentures, commercial papers, short term, long term, all kind of debts fund are there. Within debt fund you also get to know about liquid fund, which invest into short term debt products. Short term debt products are those products which is like within 91 days it has to be liquidated, it has to be converted into obligation, has to be paid, right? So debt mutual funds are there. Then you have hybrid mutual fund. I'm sure you would have heard about, this is the child plan you can take, this is the pension plan you can take, this is the monthly income plan you can take. mutual fund people keep on pitching these kind of plans. These are nothing but the hybrid products where debt and equity both are used. Now we have to learn about the index fund. So index fund is a type of equity fund only, but the fund manager, instead of directly investing and taking a decision of investing in which company, they rely on another data, and the data is this index fund could be Nifty index, it could be Bank Nifty index, it could be Sensex index, so you have to identify that how many kind of indexes are there, and within those indexes how many companies have launched index funds, keeping those indexes in mind. So the only job which mutual fund manager or the company which does in managing index mutual fund is they keep on tracking the components of these indexes and keep on matching with the weightage what has been assigned for those equity, and accordingly they manage this mutual fund, they manage this pool of fund. So index fund is one fund through can passively invest into Nifty and any other index, and you will get the return of what Nifty return is going to be in a specific time horizon. Is it safer? Yes. So in few cases senses you will see that it is safer because you do not have to do very in-depth research. You just have to believe in one theory, and the theory is stock market is here, it is not going to die, because till the time this capitalism will be there where companies have to be there in the market, companies have to generate profit, indexes will be there, and Nifty being the prime index from the largest stock exchange in India, it is going to sustain there. So when you believe in this theory and you really is happy with the return of the index itself, so let's say even if we talk about Nifty index, it started with 1000, right now it is 9,000, some time back it was 12,000 also, right? So in this scenario, what you see that even through index fund you can generate good return on your overall capital. Now here why index mutual fund? So one is like you get the passive return of what the market is giving, and then the second is, unlike the other direct equity mutual funds, here your index fund is having the fund management fee which is as low as 0.1%, right? Some cases it ranges from 0.1% to 0.5% from some of the fund houses, but since the job is just to match and track, generally fund managers or companies don't charge anything like 2.5%, but it has come down to as low as 0.1% also. So this is one method through which you can go and invest into different index mutual funds and get passive return on Indian stock market through its benchmark indexes, whichever is your liking. It could be Nifty, it could be Bank Nifty, they are all indexes, and you just have to believe into one of the index and passively do the investment. Your company related risk, company specific risk will get mitigated automatically. Well, in next class, let's be open to compare ETF with index mutual fund, index funds, and then probably this how to be passively investing or investing without any specific expert advice or your own dedicated time, how you can invest into stock market chapter will get complete. So let's jump and try to compare Nifty ETF with index funds. Thank you.